Welcome to our HighRock clients and any other listeners who have joined us this week. And thanks very much for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock. Our financial planner, Bianca Tomlinson, is also on the call, and we will have a question and answer period at the end of the call. So if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About HighRock tab. Well, let's quickly recap our themes for 2016 before we get started on what happened last week. Our overriding theme for 2016 is that financial markets will remain volatile. January saw a spike in volatility, but markets settled a bit in late February and as have settled as well in early March. But uncertainty has certainly not gone away. Financial markets are just learning how to deal with it. The big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer is not at the moment providing a lift to the domestic economy despite improving employment growth, and at the wholesale level, inventories are building while sales are sliding. Commodity prices, and especially oil, have stopped declining for the moment. Core inflation in North America has picked up, but not so in other parts of the global economy. The European Central Bank increased its monetary stimulus. The Bank of Japan had done so as well. Prior to that, the Bank of Canada is currently on hold until the March 22nd budget, and the U.S. Federal Reserve and the Bank of England will announce their latest policy decisions tomorrow and Thursday, respectively. Geopolitical wildcards like the UK leaving the European Union, the Donald Trump factor, OPEC and oil-producing nations, China, North Korea, terrorist activity, and the refugee crisis are all increasing the levels of uncertainty. As they always do, bond markets may hold the clues, but with some central banks forcing negative interest rates, the picture may be a bit distorted. Other credit markets like high yield may be telling us a bit of a different story, so we're watching them closely. Equity markets remain expensive, although somewhat less so than last May. Earnings growth has declined over the last 3 quarters and will probably decline in the first quarter of 2016. Estimates for all of 2016 continue to get revised lower. We remain in a time of lower than average returns after 6 years of above average returns, and as the cycle evolves, longer term returns are moving back toward the average. Plenty has happened since our last webinar, so let's get right to the financial markets because there is certainly lots going on there. In keeping with our key theme for 2016, it has been a wild ride since the beginning of the year. Volatility started the year off with a boom, but has eased up recently as the Bank of Japan and the European Central Bank have added further monetary stimulus with negative interest rates. Markets are now waiting for tomorrow's U.S. Federal Reserve announcement. Volatility is sitting about at its longer-term averages currently. CNN Money's Fear and Greed Index that hit a low near 9 in January has moved back into greed territory as the more stimulative central banks have forced money out of negative yielding safe assets into riskier, higher yielding assets. Markets have moved rather quickly from being oversold to overbought. We do suspect that the next move may take us lower, and we'll get to that as we move through the program today. Since our last webinar, our benchmark world equity index is stronger by about 1.5% and is now lower by only 2% on the year. Last week it was lower by about 3%, but at its worst it was down about 10%. Japan's Nikkei 225 was the best performer since last Tuesday. Australia's All Ordinaries Index was the worst performer. In December on BNN's The Close, I suggested that it might be a reasonable strategy for 2016 to be overweight the underperforming Canadian market, equity market that is, and underweight the outperforming U.S. equity market for rebalancing purposes. At this time, that strategy is working quite nicely. On our total return basis, which includes dividends and currency fluctuations, the TSX is up by 2.9%, while the S&P 500 in Canadian dollar terms is lower by 4%, which is a difference of about 6.9%. The TSX has been the best performing country index in the developed world so far this year. Well, after hitting highs last May near 63, our benchmark World Equity Index made new lows near 49 in mid-January, and then again in early February, which is about a 22% drop from the highs. It found some buying support from short covering and a little value investing after such a significant decline. The downtrend channel, however, still remains intact, as we are now experiencing lower lows and lower highs. Now, we could see buying potentially drive prices to test the top of the downtrend channel at or near the 56 level, which is close to the current price level of a little under 55. A bounce of close to 12% from the lows. So a break of that channel would change the medium-term outlook to positive. However, until this pattern and downtrend is broken, we should be on guard for further selling pressure, especially as markets are close to being close to overbought territory. Also, notice that trading volume has fallen considerably as markets rebounded from their lows. Now, without volume follow-through, this move will run out of momentum to the upside. And until we see further positive developments, we are sticking to our overweight cash thesis. A mixed week for fixed income as U.S. high yield outperformed government bonds amid a move by investors to add more risk assets on the back of more monetary stimulus from the European Central Bank. The Canada-U.S. 10-year interest rate spreads remained at 63 basis points, same place they were last week. The Bank of Canada left interest rates unchanged at last week's meeting. Tomorrow, as I said, we will get the Fed's announcement of its latest monetary policy decisions. The worst performer so far this year, natural gas, outperformed on the commodity front this week, while gold, the best performer on the year, was lower on the week. Oil has clearly broken out of the downtrend channel, but has encountered some near-term selling resistance near $40. Iran's decision to increase production will add to increased supply concerns as China's economic situation has added to lower demand concerns. And the Bloomberg Commodity Index has turned higher, but in a very modest way at the moment. The Canadian dollar continued to move higher until finding some selling resistance at the US 68 cent level on Friday before moving back. Sorry, that was not 68, that's 76 cents. Before moving back to the 75 cent US level over the last couple of days on lower oil prices. Longer term, the Canadian dollar and US dollar exchange rate remains in its long-term channel until it is able to break the 130 or 70 cent US level. Oil prices and US and Canada interest rate spreads will be the key drivers of that. The Bank of Canada would like to see it lower to make Canadian exports cheaper. We like to hold some of our client assets in US dollars, which was certainly a helpful strategy for moderating the impact of higher levels of volatility in January. Well, our benchmark World Equity Index is comprised of about 52% of U.S. companies, so We keep a very close eye on what's going on in the U.S. economy. So let's see what's going on there. The U.S. Federal Reserve raised interest rates in mid-December and held them steady in January. They saw improving labor market conditions and some increased household and business spending. We're concerned with exports and global economic and financial developments. Well, the Fed is meeting today and tomorrow and will announce their latest decision tomorrow at 2 p.m. We'll be watching that very closely. We expect that the Fed will leave rates steady, but we will be monitoring how they word their press release. Back in December, the Fed had a particularly optimistic outlook. U.S. Federal Open Market Committee members suggested an average of 4 interest rate increases in 2016. Probability suggests that this could be significantly modified, and we will see more of the dot plot chart tomorrow. Core inflation has started to move higher, approaching the Fed's 2% target. Meanwhile, jobless claims fell last week, and the trend continues to be sideways, but at lower levels of jobless claims. This leading indicator of the state of U.S. employment at the moment remains strong. However, most of the growth is and has been in lower paying jobs. Retail sales data announced today with big downward revisions to January data show that the consumer is not spending this year so far. Consumer spending, despite high employment, is struggling to break out of a flat run that included a very soft holiday season. The consumer, as you will recall, is roughly 2/3 of the U.S. economy and is key to supporting domestic economic growth, which is being offset by a slow global economy. At the wholesale level, inventories continue to build as sales decline, further pushing up the important inventory to sales ratio that has historically preceded previous recessions. High inventory warranted a slowdown in manufacturing. The manufacturing index picked up slightly in February but remains in contraction below 50. We'll see more from the industrial production data to be released tomorrow. Meanwhile, the GDP forecast for the first quarter of 2016, which had rebounded through mid-February as economic data attributed to the consumer, appeared to have improved. Now, inventory build-up and continued contraction in manufacturing data has pushed the outlook back below 2%. Then the most recent employment data pushed it back up to 2.2. However, the downward revision to January retail sales announced today has caused the first quarter expectation to be lowered to 1.9%. While the U.S. economy appears to be withstanding global economic pressures for the moment, it remains to be seen if this growth can be sustained in the current situation as China and emerging economies continue to struggle. There are lots of schools of thought on both sides of this concern. We would argue that there is still plenty of potential downside for the global economy, but the wild card is still how the U.S. economy and the U.S. consumer specifically will be impacted in the medium term. With employment growth continuing in the U.S., but the consumer not spending, this could spell trouble. We are closely monitoring this scenario for its implications on financial markets and investment strategy. It is expected that the U.S. economy will contribute over 20% to the global economic growth. One of our themes for 2016, as you may recall, wonders if that will be enough. So let's have a look at what's happening in the global economy. In the Euro area, companies represent about 16% of the world equity index. Last Thursday, Mario Draghi put his Super Mario costume back on and surprised financial markets with a number of new monetary policy measures intended to assist economic growth and spur inflation. The ECB lowered its benchmark refinancing rate by 5 basis points to a fresh record low of 0%. They increased the asset purchase program by 20 billion euros from 20 billion euros to 80 billion a month. The deposit facility rate was cut by 10 basis points to a negative 0.4%. The lending facility was lowered by 5 basis points to 0.25%, and a new series of long-term loans to banks was announced. Policymakers said interest rates are expected to remain at present or lower levels for an extended period of time, and they have cut their growth and inflation forecasts. This outlook is broadly reflected in the March 2016 European Central Bank staff macroeconomic projections for the euro area, which foresee annual real GDP increasing by 1.4% in 2016, 1.7% in 2017, and 1.8% in 2018. So still considerably lower than growth that would be desired in the euro area. Well, yesterday it was announced that industrial production in the Eurozone rose by 2.8% year over year in January compared to a downwardly revised 0.1% fall the previous month, and certainly that beat market consensus of a growth of 1.4%. It was the sharpest gain since August of 2011, boosted by higher production of consumer, capital, and intermediate goods. So some positive news for the euro area economy. Well, Japanese companies represent 8% of the world equity index. In February, the Bank of Japan surprised financial markets with their first step into negative interest rates. With last night's interest rate decision, they left their monetary policy unchanged, stating that Japan's economy had continued its moderate recovery trend, although exports and production have been sluggish due to mainly to the effects of the slowdown in emerging economies. On the domestic side, business fixed investment has been on a moderate increasing trend as corporate profits have been at high levels. Against the background of a steady improvement in the employment and income situation, private consumption has been resilient. Reflecting these developments in demand, both at home and abroad, industrial production has continued to be more or less flat. Financial conditions are highly accommodative. On the price front, for the year-on-year rate of change in the consumer price index, it's about 0%, although inflation expectations appear to be rising on the whole from a somewhat longer-term perspective. They have, in fact, recently weakened. With regard to the outlook, although sluggishness is expected to remain in the exports and production for the time being, domestic demand is likely to follow an uptrend, with a cycle from income to spending being maintained in both the household and corporate sectors, and exports are expected to increase moderately on the back of emerging economies moving out of their deceleration phase. Japan's economy is likely to be on a moderate expanding trend as a result. Of course, that certainly depends on what happens in the emerging economies. The year-on-year rate of change in the consumer price index is likely to be about 0% for the time being due to the effects of the decline in energy prices, and as the underlying trend in inflation steadily rises, they expect to see this accelerate toward 2%. Well, companies in the UK represent 7% of the global equity index. The Bank of England Monetary Policy Committee voted unanimously to maintain the bank rate at 0.5% on February the 4th. The Bank of England will announce its next interest rate decision on Thursday of this week. Britons will vote on June 23rd whether or not to remain in the European Union. There are potentially significant economic implications for the UK as their participation in the European Union will be decided at that point in time. At the moment, the polls are showing that those who wish to remain in the Union hold a slim advantage. The pound has been under continued pressure, but has bounced off recent lows. Well, Chinese companies represent 2.5% of the world equity index. On February 29th, in an aggressively stimulative move, the People's Bank of China lowered the amount of deposits banks must hold in reserve by half a percentage point. In February, China reported largest monthly drop in exports since the financial crisis. Exports fell 25.4%. Imports also declined, falling 13.8%. Factories and retailers in China put in weaker than expected performances in the first 2 months of the year as anemic demand and excess capacity continued to bear down on the world's second largest economy. Industrial production grew 5.4% in January and February compared with a year earlier, down from December's 5.9% pace. In Canada, where companies represent 3% of the world index, the Bank of Canada had an assessment of, in its most recent meeting, announced that it will wait for the upcoming federal budget to make any further monetary policy decisions, and so we have to wait till April. But in the meantime, financial vulnerabilities continue to edge higher, in part due to regional shifts in activity associated with the structural adjustment underway in Canada's economy. In our last 2 webinars, we've discussed the increase in household debt and how it has been driven by the increasing debt levels of already highly indebted households, and that the Bank of Canada's recent assessment was that financial risk scenario was elevated. Well, this week we saw data that showed us the ratio of household credit market debt to disposable income rose to 165.4% in the fourth quarter from 164.5% in the third quarter. In other words, households held $1.65 in credit market debt for every dollar of disposable income. The ratio of total household debt to total assets was largely unchanged in the fourth quarter, edging down to 17.1%. In essence, while debt levels are increasing, asset values, both financial and non-financial, have been actually increasing at a more rapid pace. The household debt service ratio, which is total payments of principal and interest as a proportion of disposable income, was still a manageable 13.8% in the fourth quarter compared with 13.5% in the third quarter. Now, the key concern is that if asset values should fall or interest rates should rise, the high debt levels will become harder to service, and that could be problematic as assets will need to be sold to pay down debt. So what do we see on the horizon? Well, bond markets tend to lead other financial markets, so let's check in with them. With the further ease of monetary policy in Germany, that yield curve has steepened slightly to contrast the Japanese yield curve, which continues to flatten. In fact, interest rates or yields on Japanese government bonds are at the moment negative all the way out to 10 years. With no change in the Canadian monetary policy for the time being, that yield curve has not changed, and with the US and UK monetary policy announcements coming over the next couple of days, there's been very little change in the yield curves at this point in time. The fact that all yield curves extend in a positive slope out to the longer term means that there is still no signs of global recession at this particular moment. Historically, high-yield bond markets lead equity markets, and while the current gap remains to be closed and makes equity markets still look relatively expensive, the gap has narrowed as record inflows into high yield have narrowed the spread to equities recently. Interestingly, Canadian high yield bonds have been lagging U.S. high yield in this most recent rally. Over the last couple of weeks, Paul has talked about the potential of increased defaults in the energy sector to impact the financial system in the longer term. So that's something we're keeping a very close eye on at this particular point in time. Moving to equity markets. When investors buy stocks, they buy a stream of future earnings. The price to earnings ratio represents a metric to measure the stock prices relative to earnings. Now, the 10-year average price to earnings ratio is 14.2 times. The 12-month forward price to earnings ratio is currently at a rather expensive 16.1. It's the same as it was at this time last week. Now, at the equity market highs back in May of 2015, it was 17.1. At the equity market lows, it was closer to 14.9, just to give you a little idea of the range at this point in time. Now, as a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is a negative 8.3%, which is below the expected earnings growth as at December 31st, which was just a little above zero. This would be the fourth consecutive quarter of negative earnings growth. For all of 2016, analysts are projecting earnings growth to increase by 2.7%. At the beginning of the year, analysts had projected 2016 earnings growth of 7.4%. So when that green dotted line, the S&P 500 prices, intersects with the blue line, the S&P 500 earnings, we can become a little bit more comfortable buying S&P 500 companies. But until then, we are not impressed and therefore not inclined to be buyers. Well, we have maintained for almost a year now that stocks were expensive on the many different metrics that we monitor. So the big question is, who's doing all the buying? Well, we've mentioned this in the past, but I thought I'd revisit this. Corporations buying their own shares back have really been driving the market. And this graph really tells that story. The white line shows the amount of corporate buybacks, which are reaching levels not seen since 2007. Now, instead of paying out dividends or investing in capital expenditures for future growth, corporations have been buying back their own shares and, as a result, driving share prices higher. Now, to a degree, this becomes self-serving as chief executives are often compensated on their company's share price. Retail investor buying of mutual funds peaked in the final quarter of 2014, as shown by the bar graph of money flowing in and out of mutual funds. 2015 and the beginning of this year show significant outflows. Now, during earnings announcement season, corporations are usually absent from the market, which explains to a degree the recent volatility. Investor selling in January and February drove share prices down, but once the earnings announcement season ended and corporate buybacks resumed, prices jumped higher once again. On an earnings per share basis, earnings per share become exaggerated on a historical basis as corporate buybacks have reduced the amount of outstanding shares. Once again, overstating the value of share prices. Furthermore, companies that participate in share buybacks often borrow to raise the necessary cash to make the purchases, increasing their debt levels. Now, this may be fine as long as interest rates remain low and the cost of borrowing is minimal. However, it could be problematic as interest rates rise or borrowing conditions become more difficult. Well, the recent rally in stocks has pushed the enterprise value to earnings ratio higher, back towards 13 times and well above the longer-term average near 10.7 times. This has prompted us to continue to, or to take some sales, which we did a couple of weeks ago, to further lighten our exposure to expensive U.S. equities. So we remain very cautious. Now, when investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. That trend definitely inspires caution for us towards equity markets. When the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies, and it is considered unhealthy. When markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied now more, while the broader Russell 2000 has lagged. This also makes us cautious. So what does it all mean? Well, since last May, we have taken a defensive posture to investing, and in light of our key theme for 2016, we remain defensive, so nothing has changed on that front. We have, when prices came down, picked away at some value opportunities, but we do remain overweight cash for the time being. Central bankers and most economic forecasters are uncertain of the path of the global economy. So are we, and as Paul suggested in the Globe and Mail article a while back, we are somewhat worried about the prospect of deflation and its effect on capital markets. Our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to be and stay fully invested at all times. That is why most advisors might recommend sitting tight on a fully invested strategy. In many cases, as non-discretionary advisors are required to do, it is significantly more difficult and time-consuming for advisors to adjust assets and positions one household at a time. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Now, cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. With equity market values having fallen so rapidly to begin 2016, we were able to find some opportunities to add reasonably cheap assets to client portfolios. However, this does not change our defensive strategy. We are being very patient and only adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness and assets with better value if and when we should get there. If we don't, we can and will adjust our strategy accordingly and quickly. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance, and that is how we justify our fees. Well, our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and a tactical mid and small cap companies model. Because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in clients' accounts, the underweight exposure to equity markets, and the overweight exposure to safe government bond markets helps to mitigate the impact of volatility on our portfolios. So far this year, our global benchmark equity index is down about 2%, as I mentioned earlier. A typical 60% equity portfolio, 40% fixed income portfolio built with our models is now pretty close to flat on the year, depending on the structure. This is a significant mitigation of risk and volatility and is part of our ongoing active management. Some of you may have received an email with a gain-loss report and some checklist of all of the different tax slips. Some may not have yet received that. We are in the process of sending that. But if you have any questions about your tax issues, please make sure to give us a call. Get in touch with us. We are here to be able to help you. Okay, well, let's look at what's ahead of on next week's schedule. As I've mentioned, tomorrow we get the Federal Reserve's interest rate decision. We also get CPI and industrial production data out of the U.S. On Thursday, we're going to get the Bank of England's interest rate decision, and we'll see Euro area February consumer price index. On Friday, it's all about Canada, February retail sales, and February CPI. Next week actually looks very quiet until Tuesday. We'll get some CPI numbers from the UK, and of course, our HIROC webinar. Well, that's it for today's discussion. If anyone is listening might have a question, please feel free to ask it now.
Hey, Scott, it's Paul.
Yes, Paul.
I have a question. Could you go back to slide 59? And we show this slide quite often. Maybe you can go back on your screen.
It's a tall order, but I'll get there.
One more. There you go.
That's the one?
Yeah, so my question would, and we show this every week, and I think we've had a really good call on it, and that's part of what drives our concern right now. But, you know, in the bottom right of the screen, you put in earnings growth expectations for the first quarter of 16 and total 16, and obviously they've come down a fair bit, and we're talking about 3 successive quarters of negative growth in earnings. But what happens if those earnings actually continue to drop? So the blue line moves down to the bottom right. You know, it starts moving lower and lower. Then we're going to have a further gap. I mean, obviously stock prices are going to move down with it, I would think, and in more severe terms. But that blue line has really been, even with kind of negative earnings growth expectations and some of the past 3 quarters being negative, it's really kind of just moving sideways. Like, when's it going to start moving down?
Well, I would say that it actually is moving down. I mean, that blue line is taken over an extremely long period of time, so it's hard to see the sort of the week-to-week movements, but it actually has been moving down. I mean, it's tough to see, but it's starting to move down. Don't forget that we've really only been revising earnings growth, expected earnings growth, lower very recently. So most importantly, you know, if you look at the 2016 earnings growth, the total for the total year, going from 7.4 down to 2.7, that's really, I think, crucial. But that gap is widening as S&P 500 prices have jumped up, and you're starting to see some downward movement in that blue line. But it's pretty subtle at the moment.
Yeah, I guess if we look at it on a shorter term basis on the chart, we probably notice it more. But it sure is interesting to look at the dotted green line, the S&P 500, like how volatile that has been with earnings, you know, not really moving a ton. And look at that movement in stocks. It's huge, volatility.
You know, I think that comes into play with a lot, and has a lot to do with those corporate buybacks. As corporate, and as I mentioned, there's a period of time when corporations, especially during the announcement of earnings season, corporations aren't buying, and then you get greater degrees of volatility as real selling enters the market. And you know, has a lot to do with some of the volatility that we've been seeing, obviously.
Okay, that's great. Thank you.
Now I shall get myself back to where I was and finish up my, obviously we've now, Paul, run out of time, but I didn't think we had any client questions, so not a worry. But if anybody's listening and has a question, wishes to email us, we're always very happy for you to send us your questions. We also want to get feedback on these webinars. We want to know what you like, what you don't like, what you might like to see us cover. But as always, I want to take the moment to thank everybody for tuning in. Have an excellent rest of the week and a wonderful weekend. Don't forget to tune in next Tuesday. And until then, this is Scott Thomason signing off.